Welcome to Gen Z Money, Episode 2. Do not pay someone to repair your credit. You can 100% do it on your own. All you need is discipline and knowledge.
Even if my jokes aren't funny, my tongue tied up on it, and I don't need to speak a single word, 'cause you got me
What's going on, guys? Welcome to the Gen Z Money Podcast, where we turn financial peace from a theory to your reality. I'm your host, James Bowman, and today we're going to kick it to the basics, and we're going to be talking about your credit score. Yes, that evil little score that can make or break a person, literally. And there's a lot that goes into the credit score. I'm going to be trying to cover a lot of things and help you guys not only increase your credit score, but at least understand how it's being calculated and things like that. So let's get right into it. What is your credit score? Honestly, it's very simple. Your credit score is just a score that determines your ability to manage your debt. Now, I'm going to do another podcast on the different types of debts and good debt, bad debt, things like that. But essentially, I wanted to do this first to give you guys an understanding of where the score comes from. Everybody has a credit score if they've taken out debt. Now, I'll get into it later, but there is something called an undetermined credit score, which I consider it's still a credit score, but it's a little bit different from an arbitrary number that's normally given. What is the credit score not? So your credit score is not an indication of your wealth. You can have an 800 credit score and have $0 in the bank. That's the reality of it. And that's why a lot of people don't really vet a person based on their credit score. It's normally institutions that do so, like banks, other types of lenders, and other people other than just regular people. So it's not an indication of wealth. It doesn't show that you have money. It doesn't show that you make a lot of money. A person that makes $1 a year can still have an 800 credit score, which is considered, extremely high. So I just wanted to cover that base because a lot of people do have high credit scores, but unfortunately, they're still not building wealth. Yes, you can use your credit score to build wealth. It can be an amazing tool, but as for every tool, to everyone, you have to use it in order to benefit from it. So let's get into the uses of your credit score. So there are a lot of different people that can benefit from pulling a credit score from you. Just to name a few, anytime you go to do a car purchase that you're taking out a loan or any loan in general, whether it's a credit card, a personal loan, payday lender, anything like that. Or maybe not payday lenders. I've never used one, so I'm not even sure if they run your credit. But anytime you're taking out a loan, most of the time they're going to run your credit. And like I said, all it is an arbitrary number that's determined by an algorithm that the different credit bureaus have in order to just to see how you manage your debt. Are you going to be able to pay them back if they lend you the money? Are you going to pay them back on time? Are you going to pay them back in full? Are you going to pay them back early? This is what the score gives them. But there are also other people who pull it. For example, utility companies. A lot of times they will pull your credit in order to see if they're going to require you to put a deposit down. Because if they pull your credit and they realize, okay, the last place you lived, you didn't pay your last water bill for 6 months, they're going to require a deposit because they don't want you to do the same thing to them. So that'll be for electric, trash, sewer, anything along those lines that go for utilities for your household. Another place that will run your credit are phone companies. Not only to see if you if you will pay your bill on time. But a lot of times when you purchase a phone, you're on financing for it for anywhere from 1 year to 3 years, is what I've seen. And they want to know that if they give you this phone, that you're going to make the payments not only for the bill, but also make payments towards the phone every month. So, with that being said, it's a great reason for them to want to know if you're trustworthy. It's just a trust number. Also, when you try and rent an apartment or a house or even a room, a lot of the time the property managers and the landlords, they want to see your credit score, because let's be honest, there if you're not going to pay, for example, the utility companies, then what makes us think that you're going to pay your rent? Because I think electricity is a lot more important than a rent payment. You can go a few months without paying your rent, and you got a little leeway between the legal system and stuff like that. Utility companies don't play. You don't pay your water bill on time, and they're cutting your water off. Now you have to pay an activation fee and stuff like that. So, and also, if you're not making your car payments on time, if you're not making anything that's reported on your credit, if you're not making those on time, a lot of times landlords and property managers will look at your credit and determine if they want to rent to you. And credit is not a protected class, so there are protected classes. For example, race, ethnicity, religious beliefs, your family's size, and things like that, that you cannot be disqualified for when renting from a property manager and stuff like that. Those aren't all of the protected classes, but those are some. But your credit score, at least in most states, I know there's some crazy states out there, that is not a protected class. Like if you come up with a very low credit score, they could turn you away at just that reason, period. And the biggest one, at least for me, because I told you guys in episodes prior that I'm a big real estate guy. And so when you go to purchase a house or any property, 9 times out of 10, they're going to run your credit. And when they do, this determines what kind of interest rate you're going to get. The higher your credit score, the more the banks trust you, the more they want to lend to you, which is the less they're going to charge you. So, and it could be a big difference. It could be, up to 2%. And that might not seem like a big difference, of a 2% difference. But when you're talking about hundreds of thousands of dollars over the span of 15 to 30 years, that interest really adds up. And of course, in future episodes, I'm going to go into the different interest rates and how it can really affect your overall payouts and things like that for a home and things like that. So don't worry, guys, I got it coming. But, that is just something that anytime you're borrowing money, especially the more money you're borrowing, it's going to make a big difference on credit, your interest paid and things like that. So we just purchased a property not too long ago. I do have a pretty high credit score. And so I qualified for the best rate that they had at the time. But someone who has a lower credit score that's deemed, bad credit, they will either get denied for the loan altogether, which means the banks don't even want to take a chance on you, or they'll give you a ridiculously high interest rate to, one, either try and get you to not take out the loan, or it's a high risk, high reward game where they're going to receive more money from you over time, just for taking the risk with you. So there are three main credit agencies. You have Experian, Equifax, and TransUnion. And each of them have their own rating system on how they determine your credit score. They all use the same factors, but there's no X plus Y equals Z to any of them. So when you go to each one, you might have a different score at each one because they have their own percentages and things like that. I know that there are names for the different calculation methods. I know one is named FICO, but to be honest, that's the only one I've ever heard of. But I know there are others out there that they use to determine it. And your credit score can range anywhere between, I think the lowest it can go is 350, and the highest it can go is 850. But to be honest with you, even though it's a 500 gap in points, in order to be determined as good credit, I think you have to be above 680 area, 680, 685 to be considered good credit. And anything below 680 is really considered bad credit. So when you look at the range, you might be at a 600 and think you're like right in the middle between 350 and 850, but really you still have bad credit to the institutions that are lending. So you want to really be above that 680 mark to be considered good credit. And again, there is another score, which is basically a zero, which means your credit is undeterminable. But I'm going to get to that later in the podcast. So your credit score is calculated on 6 different criteria for the most part, and each criteria weighs a different amount, which is why you can't just go online and plug it into a calculator and get your absolute primary score, because each scoring method weighs them differently. But in general, they all go by the same principle of how much each thing weighs. So the most important thing impacting your credit is your payment history. The more on-time payments that you have in your lifetime over your credit history, the better your score is going to be. This is the most heavily weighted one. I mean, let's say you have very low credit history, let's say you have 1 year, you've had one credit card, you've had 12 on-time payments. If you miss that 13th on-time payment, now you've been late 13 out of 12 payments, which is what, 8%. So now you've missed 8% of your on-time payments. And it's a sucky way to score, honestly, because when you don't have many credit lines and you don't have many accounts open that are reporting on-time payments, one missed payment can really, really hurt you, and it'd be really, really hard to recover. So that's why it's really important for us as Gen Z and maybe the millennials or older generations that are listening to this podcast is to really, really start early and be extremely diligent on making sure all of your payments are made on time, no matter the circumstance. I'm not telling you to not eat in order to make your car payment, but if you can't make your car payment, then you should probably get rid of the car. But that's another conversation for another podcast. The point I'm trying to stress to you guys is that your payment history is the most weighted. If you miss one payment, it could drop your score 50 plus points, depending on how long you've had credit and things like that. So it is by far the most important. I think the easiest way to get around this is every single one of my bills is on auto pay. And I have a good idea of when they will be paid throughout the month, but I don't have to go in and every single due date just to make payments. Now, I don't have many payments. The only debt I have personally is on my properties. So all of those are set up on automatic payment. I know they're all coming out the first of the month, but also other bills, things like my utility bills, phone companies, and things like that. Like I set them on automatic payments. That way I don't have to worry about it. And yes, that requires you to save more, spend less, but I think it is the easiest manageable way to make sure that your payment history stays a-okay, because like I said, one missed payment can really hurt you, and it could take you a really long time to basically get to that. So for example, once you drop from 100% on-time payments to 99%, that means it's going to drop your score, even that 1%. So that means you can make 99 on-time payments across multiple accounts, and you make one late payment by 30 days on one account, and you go from 100% on time to 99, and it will drop your score. And it's probably going to take another 99 payments on time in order to get it back up to round up to 100%. So that's how important it is. And again, it's the heaviest of the heavy on the credit score calculations, but it's for good reasons, because people want to know that you're paying all your bills on time and you're paying them in full and all that. But that brings us to our next heaviest calculation, which is derogatory marks. So when I say derogatory marks, I'm referring to things such as bankruptcies, foreclosures, any judgments that have been placed against you, any things you have in debt collections, etc. So I'll tell a little story. When me and my wife, I hope she doesn't hate me for this, but when me and my wife first got married, we went ahead and pulled up her credit score using the agencies, and she had never had any credit cards, never took out any loans or anything like that besides student loans at the time. And we pulled up her credit and it was extremely low. I mean, it was bad. And the reason it was so bad is because she had one or two derogatory marks from debt collections that were opened up in her name. They were things that were opened up in her name she had no knowledge of. The bills never got paid, and so they reported it to the agencies. Luckily, these debts were anywhere from like $100 to $200, and so of course we were married. I was in the military at the time. We were able to go ahead, call them up that day, and settle them. And by the next month, they just removed her off her credit 100% right then and there. So if you have any bills you haven't paid, for example, like an old credit card bill that you just stopped paying, that went to a collections agency, and you get those annoying phone calls and things like that, then you definitely want to take care of those because that has a major impact. As for bankruptcies, those who do not know what a bankruptcy is essentially when your ability to pay off the debt you've taken out is no longer sufficient. So let's say you have $100,000 in debt. Depending on the debt, you can file for a Chapter 7 or Chapter 13 bankruptcy, and the government will discharge the debt from you. You might have monthly payments, but that will stay on your credit score for 7 years. And so it's going to be a hard mark on your credit for 7 years, and there's not much you can do about it. But people do it, and I'm not going to sit here and judge anybody who's gone through bankruptcy or who might go through bankruptcy. It's there for a reason. I would just say don't abuse it because it does have a very long impact on your credit, and the odds of you getting loans after that aren't ridiculous, like getting a home loan and things like that. I've heard that normally after about 3 years of a bankruptcy, then banks will begin to start looking to loan to you again, as long as you can show that you've come out of the bankruptcy. But it will stay on your credit, and it's going to hurt you. It's going to take you, no matter where your credit score is, it's going to tank it to bad credit, and it's going to stay there for a very long time until the 7 years is up and it's removed from your credit. Foreclosure is the same thing, except a foreclosure is if you have a mortgage payment on your home and you can no longer afford to make that mortgage payment, then the bank forecloses on you, and they essentially take the property from you. So they take the property and they'll either sell it or whatever to basically discharge the mortgage from you. So let's just say you owe $100,000 on your home. The home's worth $200,000. You can't make the mortgage payment, but you don't want to sell it. The bank will come in. They will take it from you because, of course, they have a lien on the property, which means if you don't pay them, they have ownership to the property through the courts and things like that. And yeah, they will come in and they will sell it to get rid of that $100,000 debt. And then judgments, of course, I'm sure you guys know about judgments, but anything, if you've gone to court, you've been sued or anything like that, and you haven't paid those judgments, if you don't pay them in a timely manner, they can show up on your credit report. And until they get paid or they get settled for less, they will remain on your credit. So moving on to the third criteria, credit utilization. So what is credit utilization? Credit utilization is essentially they take a percentage of the total debt that you have available to you, and then they divide it by the debt you've used of that to come up with how much debt are you utilizing. So I'm going to give you a hard example. For example, let's say you have a credit card that has a $1,000 credit limit, and this is the only debt you have. That means you have $1,000 of available debt that you can use. Every $100 or every $10 you use of that is 1% of your credit utilized. So you always want to stay below 30% utilization across the board on all of your debt you have available. Now, this doesn't include mortgages, and it doesn't include things like car payments. It's normally for revolving debt, whether you have a line of credit, you have credit cards, things like that, HELOCs. So a home equity line of credit, which is just a line of credit with your house's collateral. But you want to stay total below 30%. Well, James, how do you do that? Well, I'll tell you. There are two ways. Either you can pay your debt down and keep a low balance on your cards. I prefer pay them off every month, but I understand everyone doesn't do that for their own reasons, and that's fine. Or increase the amount of debt available to you. So if you have a card that has $1,000 limit and you have a card that has a $10,000 limit, well, those 30% are much different. 30% of 1,000 is $300. 30% of 10,000 is $3,000. So the more debt you have available to you, it's a lot easier to stay below that utilization. And so that's going to be a big part of calculating your credit, because they see if you take out a $10,000 credit card and you spend $10,000, the institutions and the banks are going to look at you and they're going to think, okay, if I give them a $5,000 credit card limit, they're going to go out and spend all $5,000 and they're just going to make the minimum payments. We're never going to get our money back, and we might have to sue them for it and get a judgment, going back to derogatory marks. So staying below that 30%, they're like, okay, so this is James, and he has, let's say, $20,000 in available credit across all of his credit cards, and he's only used 2,000 of it. So he's only used 10% available. So we can lend him more because we know he's not going to just spend all of the money, and he's going to be paying us back regularly. So we're going to lend to him. And this is what increases your score, staying below 30% of your total allowed credit available to you. Moving on to the fourth credit score calculation is the average age of credit history. Now, this one is something that you have control over, but it's not much control. The first three things you have a lot of control over. One thing you can't control is your age. And yeah, so it's a lot harder to improve this at a younger age besides opening many credit lines. But essentially what this is they take an average of all of your current debts open. So let's say you've had a credit card for 1 year. You just opened a credit card yesterday. So you have 2 credit cards. The average of those 2 is 6 months, because what's between 1 day and 1 year? It's 6 months. So that means the average age of your credit is 6 months old. Institutions and banks that lend out money, they love to see people with really long track records of debt that they're paying on time, paying in full, and things like that. When you see someone who's done it repeatedly for 10 years, 15 years, 20 years, what makes you think they're just going to wake up one day and be like, okay, I don't want to do this anymore. I don't want to pay my cards anymore. I don't want to, none of that. I just want to give up. And the odds of that happening is nothing. If you can be solid for 10 to 15 years of being disciplined, using debt properly and things like that, then you're not just going to wake up one day and change that. And so that's why that's a big calculation into calculating your credit score. They just want to see the average of your accounts. So how do you improve this? Well, it's not complicated. It's just extremely boring. Open up your accounts and leave them open. I'll give you an example of this. I told you guys in the first episode that I ended up paying my car off early. Well, that was kind of facetious because what I did was instead of paying off the loan in full, because I knew as soon as I made the final payment, the account would close, and it was a account with a very very long credit history of 3 years at the time. I had a loan for the total of 6 years. So because I wanted to get that whole 6 years to keep my credit high, I left $1 on my car loan, and I paid interest on that dollar for 3 whole years. I never made another payment on it. My last payment was due at February of 2022, so it hasn't even come up yet. And I just left it there. And every month, because I was so far ahead in my car payments, basically the whole loan was done besides the dollar, they were still reporting it as on time every single month. So not only did this increase my payment history by reporting another payment every month, but it also improved my average age of credit history. So that really helped me out there because I didn't have to worry about this loan for 3 years, but it was still positively impacting my credit. In the last month or so after I purchased my last property, I decided to go ahead and just pay that off because when I do, I know what's going to happen. My credit is going to drop due to closing that account that's been open for the last 6 years, or 5 years. I'm sorry, I can't count. Yeah, 5 years. I know my credit score is going to drop, but I can take that now because I have months before I plan on purchasing again. So I have time to build up my credit more with more on-time payments, less utilization, no derogatory marks, things like that. So that's what I did. And that's a way to get around it. If you have that credit card, let's just say you have your first credit card ever and you never use it. It's just sitting in your wallet collecting dust and you got no balance on it, nothing. Just leave it open. You can cut the card up, you can burn it. Just leave the account open because it's going to continue reporting on-time payments, even though you're not using the card. It might go inactive, but that's not a big deal. You maybe charge it once a month or whatever. Keep the account open, 5, 6, 7 years. That way, when you open up newer accounts, it doesn't hit your credit as hard. And I hope I'm being clear on that. I hope I'm making sense to you guys because it's kind of difficult to explain, but just see it as an average of all of your accounts that are currently open. What is the average amount of time they've been open? The longer that is, the better it does to your credit. Moving on to your total amount of accounts opened. So this is another one you can control, but again, it's kind of wishy-washy. So essentially, all they do is they just look at all of your current accounts open. How many credit cards do you have? How many mortgages do you have? How many whatever is reporting on your credit? How many do you have open total? The more you have open and the more you're paying on, the more trustworthy you are. Now I'm going to say that again. The more accounts you have open, the more accounts you're paying on time, in full, every due date, the more trustworthy you are. Because if one person has one account that they pay on time, they're not going to look at it the same as one person who has 5 accounts and he pays all 5 of them on time. So it's quite simple. Again, it's something that you don't want to just go open up 100 accounts and leave them open forever because then you can seem as a risk. You're opening up too much debt in a short amount of time, things like that. But that's another issue on another day. But essentially, that's what it is. How many accounts do you have opened and how many are you making on time? And it gives more trust to the score, If somebody has 5 cars and they're making all their payments on all 5 of their cars and they want to get a 6th car, then I'll be like, okay, he's paying all 5. Let's go get the 6. Here's the money. But if one guy's got 1 car he's paying on time and he wants to go get another, like, whoa, now you're doubling the amount of payments you have. I don't know, guys. We're going to have to look at this one. We're going to have to charge him more because he might default. But we're just going to go over the last credit score calculator, which is hard inquiries. What is a hard inquiry? Basically, it's just when your credit was pulled by someone. Like I said, anytime you go to purchase a car with a car note, you open up utilities, you open up phone, they pull your credit. It's called a credit pull. It's called a credit inquiry. The more of those you have, the more risky you seem to the banks. Because if someone comes in and they want a credit card from you as the bank, but you look at their credit and they just open up 10 other credit cards with 10 other banks, you might be thinking, okay, wait a minute, what is this guy up to? Why is he opening up so many credit cards in such a short amount of time? Maybe he's planning on just maxing them all out and never paying them. Oh, we're not going to open up a card for this guy. We got to get him out of here. And that's all a hard inquiry is. It's just when they pull your credit. The less you have, and I want to say they fall off every 2 years. So once it's become 2 years old, it just comes off your credit like it never happened. So yeah, that's a hard inquiry. It's pretty simple. Just anytime it's pulled, the less pulls you have, the better your credit will be. But as I put these in order of most important to least important in calculating your credit, you have to understand a hard inquiry isn't gonna kill you. It's not gonna tank your score. Like, it might drop your score 1 or 2 points, but having the account open, having it increasing your average credit history and things like that, it's gonna rebound super fast. So don't ever think, you know what, I don't want my credit score to drop, so I'm not gonna apply for any lines of credit or anything like that. It's not gonna kill you. It really is the smallest. It's calculated in there, but it's definitely the smallest. So those are all 6 of the ways your credit score is calculated. So now that we've talked about that, let's just go over real quick good credit score, bad credit score, and no credit score determined. And I'm just going to go over what they are, how to get them, which I've already kind of covered, and how to keep them if you want to. So I'm going to say, this is my opinion. Every single institution has their own standards. Every single person has their own standards. So these are my standards, okay? So don't come in here and be like, oh, James is stupid. James doesn't know what he's talking about. I don't want to hear it. So what do I determine a good credit score? I determine a good credit score of 680 and above. Why 680? Because you're 680, in order to achieve a 680, you have to have many payment histories, not many late payments. You have to have low credit utilization. You can't have any derogatory marks in order to have a 680. And you just have to be above average. Well, I call it good, but we're going to say it's just above average is 680. So how do you get a 680? Well, you make your payments on time. You utilize less than 30% of your debt. I'd say less than 10, personally. You keep those derogatory marks. You make sure you're making all your payments. You're paying everybody you owe money to. You keep those account opens for a long time. And you have several accounts opened at all times. And if you do all of that, you're going to maintain. It's not hard at all to get a good credit score. It's not difficult. It just takes a while. If you do the boring stuff for a long time, you will get a credit score. There's no magic pill for it, okay? So what does that mean? That means a bad credit score is anything below 680. Now, you can still get plenty of car loans below 680. You can still get mortgages below 680. I think the lowest credit score they'll take for a mortgage right now is like 580 for an FHA loan. I might be wrong, but I think this is about 580. So you can still do all these things, but you're not going to get the best benefits. You're not going to get the best interest rates. You're not going to get the best loan terms. You're not going to get anything the best. You're going to get average or below average interest rates and things like that on loans. Or, you might get denied for some things. Like if you want to buy an investment property, but your score is below a 680, the banks are going to look at you and be like, I don't know about this James guy. He's got the funds, he's got the money and stuff, but looks like he's missed a bunch of payments on his last mortgage. So, he went through a foreclosure a few years ago. We might have to keep an eye on him. And it's just the reality, man. You have to understand these institutions, they want to make money. In order to make money, they have to lend out money. They have to. Like, you cannot make money without lending out money to your people to pay you interest. So they want to. They really want to. But they have to do it in the most sane and safe way. So they're going to look at you a little bit sideways below 680, but a lot of institutions, banks, lenders, and things like that, they will work with you. And then we're going to go over the indeterminable credit. Indeterminable credit. The way to best explain it, you have a zero credit score. It means you don't owe anybody any money. You don't make payments on anything because you don't owe anybody any payments on anything. And you don't take out any loans. You haven't tried to take out any loans. You're not going to take out any loans. None of that. So that gives you an undeterminable credit. What does that mean, James? What does it mean to have a zero credit score? In my opinion, it's not good and it's not bad. It's just it is what it is. Yes, you can still go out and get loans. You can still go out and get mortgages if you find someone who can do manual underwriting, which I'll talk about in another podcast, getting mortgages without a credit score, things like that. So it's not good. It's not bad. It's just, it is what it is. You don't borrow money from anybody and you don't owe anybody money. That's fine. There's absolutely nothing wrong with having a zero credit score, in my opinion. I would rather people have no credit score, a zero credit score, an undeterminable credit score, than to have a bad credit score. And that's just my opinion, because then they can't come back and say, oh, well, he makes his payments late, so we're going to charge him more. It's like, no. You don't know what I do, because I don't have a credit. Like, nobody's reporting on me. And just know, if you do have an undetermined credit score, and let's just say you decide you're going to go out and get a mortgage, having that mortgage is now going to give you a credit score, depending on how you pay on it, how anything like that. So you can always go back to having a credit score if you start opening up and borrowing money from people, whether it's for a home purchase, car, whatever. It can always go back. How do you get an undeterminable credit score? Quite simple. You pay off all your debts. So if you have any credit cards, you pay them off and you close all of the accounts. Once you have no accounts open, you have no outstanding debt, you have no derogatory marks, everybody who's lent you money or anybody you owe money to has been paid off, you, after about 6 months to a year, your credit score is going to go to zero, because they don't have enough information in order to determine a credit score. And when they don't, they just give you a zero, undetermined credit. And like I said, it is what it is. I have no problem with people who have an undetermined score. I see that as a better option than to have a bad credit. So, and now to conclude the show, I am going to give you guys my best way in order to fix, if you have bad credit and you want to go to either no credit determined, like a zero credit score, or if you want to strive for a good credit score. I'm going to tell you how I think you should do it. And the number one thing is, heed this: do not pay someone to repair your credit. Do not pay someone to repair your credit. You can 100% do it on your own. All you need is discipline and knowledge. So the first thing I would do, which is the easiest, yes, it's going to take about an hour of your time. It's going to take a couple stamps, and you got to go to the post office. I am going to provide in the show notes templates to letters. And these letters you can send to the credit bureaus and dispute anything on your credit. Anything that you might deem as false information. Let's say someone said you were late on a payment and you weren't. Things like that. You can put it in this letter and send it to the credit bureaus yourself. And it's on the burden of the creditor, the person who lent you the money. It's the burden of them to prove that you're either late or you owe the money. And normally they have about 30 days to do it. If they don't do it within 30 days, then the credit bureau is required to take it off your credit and it goes bye-bye. And unless they can come up with proof from that point on, it would never come back onto your credit. It's free to do. You can do it on your own. I highly suggest everyone do it. You can dispute anything. You can dispute your payment history, credit utilization, derogatory marks, the amount of accounts open, hard inquiries. You can dispute it all. So do that. for each agency, send one to Experian, one to Equifax, one to TransUnion, and let them get the burden of proof to prove that you did these bad things or whatever the case is. And then the next thing is just start paying off your debts. As I said before, I'd rather you have no credit than bad credit. So if you got that credit card, start aggressively paying it off. It's costing you money every single month. Get that thing out of your life. Pay it off, close it down, and that's it. If you do that, let's just say you owe an outstanding of $5,000 to a wide variety of people, and you just decide for 6 months, I'm going to work my butt off. I'm going to pay off that $5,000. I'm not going to owe anybody anything. I'm going to close all of my accounts, and my credit score is going to go to zero in 6 months to a year. That is the way to go. It won't get you good credit, but it's going to get you to that zero. And then if you want to go forward with getting good credit from that point, then you can do so. But it's a lot easier to start from zero than to start from bad credit. So that's how you should fix your credit. As I said, in the show notes, I'm going to provide the letter templates for that, or the website I found them on. And that way you guys can do it. And you can always message me on any of my social media and I can help you. I'm not going to do it for you, but I'm always willing to help you guys out because I want you guys to have great credit. So here's a tip for you guys. If you don't know what your credit is, or you want to see all of the things that are reported on your credit currently that may be accurate or inaccurate, I highly suggest, and this is not sponsored by them, but I highly suggest downloading the Credit Karma app on your phone, creating an account just to monitor your credit. I'd say at least once a quarter to make sure not only are there no new open lines on your credit that you didn't do, which would be fraudulent, but to also make sure that people are reporting accurate information that's going to be impacting your credit. It's super duper important that you guys monitor it, because otherwise you could look up one day and have 10 credit cards that you never opened, completely tanking your credit. So I highly suggest you guys give that some thought. And that is going to wrap up this episode, guys. If you guys have any questions about this episode, and if there's anything that I did not cover that you guys think I should have covered, please, please, please do not hesitate to reach out to me on any of my social medias at Gen Z Money, no Y. And I will promise you, I'm going to answer your questions, and I'm going to, help you guys through this if you need it. But without further ado, I'm James Bowman, and always remember, you're only as secure as your ability to perform, so spend your life accumulating assets that can perform for you. Peace out, guys.
Even if my jokes aren't funny, my